Hey team, it's Ray Campbell, Fairway Independent Mortgage. It is Friday, August 11th, and we have not so good news, and we have some, light at the end of the tunnel kind of news for you. So, real quick to wrap it up, this week was a rough one. We expected a lot of things to happen, and everything happened as expected, except for the response from mortgage bonds and interest rates. There's a lot going on as far as people talking about why that happened, what happened, and the honest answer is nobody really knows. We're not really going to know or understand really, I think, until we, in the future, and then look back at basically this whole scenario and situation, and people can spend 6 months, a year, 2 years dissecting everything that happened, when the reports happened, what came out, what information, and how everything reacted. This is, we're living through it, and we just got to deal with what we have going on right now, and and take it from there. So good news is that everything that we expected as far as reports coming out, Treasury auctions, all of that, it all came out in our favor, including the inflation number. And it was supposed to be a week all about the CPI report, the inflation numbers showing the inflation is coming down. That's supposed to lead to, of course, the Federal Reserve slowing down and maybe hitting pause or not raising rates in September. They wanted the information to follow up on the June numbers that were released in July, and now we've got the August numbers that are released, and that's covering July numbers. So everything pointed in the right direction, and for some unknown reason, again, you could talk to a lot of different experts and economists around the country, and you can watch whatever news you want to watch. There's a lot of speculation as to why, but the bottom line is nobody really knows why it's happening the way it's happening, and interest rates have gone up, okay? So that's fine, right? So the light at the end of the tunnel, here's where this leaves us, okay? This is a turning point. So all of that information is what the Federal Reserve was looking for to be able to hit pause. So with that, there's a couple of things that are happening that are good for us. So interest rates went up. Okay, fine. It is what it is, right? We're all being creative and working on ways to get around the fact that interest rates are in the high sevens. Nobody's happy about it. Nobody likes it. Everybody's shopping around, shopping lender to lender to lender. Please make sure I saw, I don't know, 5-6 different loan estimates this week where people thought they were getting something that they really weren't. Yesterday evening, looked at one where they were getting 5.5%. I said, there's no possible way you're getting 5.5%. We followed through, and I got asked more questions. It turns out they were paying 4 discount points, $32,000 in discount points to get 5.5%, which is absolutely insane, but that's how they qualified. That's the only way it worked. Crazy things are going on. Just make sure that your people are getting the numbers and they're looking at them, getting what they actually think they're getting, okay? But buying down interest rates, temporary buy downs, if you don't know what those are, how to leverage them for your buyers and also for your listings, let me know. Let's have a conversation. We've got a lot of tools we can put in front of you to discuss those with your clients and see what those numbers look like and how that benefits them and the strategies around them. So that's where we stand. And where we're going is gets a little technical, but I'll go through it pretty quickly. Right now, we have an inverted yield curve. What that means is short-term investments are paying more than long-term investments. That's bad for interest rates. With the information we have now, and when the Fed stops doing what they're doing, investors are going to change their positions. This happens periodically, usually before a recession, and is one of the indicators, but what happens then is, of course, the ARM loans go away. Those aren't even an option because the rates are horrible, right? You got to pay 3 points to get the same rate you could on a 30-year fixed. 15-year fixed, price one yesterday, is only about 1/8 to 1/4% lower than the 30-year fixed. Why would you do it? Those kinds of things and conversations are happening, and with the reports that are coming out today, and a lot of people are looking at it saying, okay, this is what we needed. This should be the turning point. And what we've seen in the last week that is the most positive thing that I can find, essentially, is that the spread between 2-year and 10-year treasuries, which is what we look at for the yield curve, actually compressed quite a bit this week, which is a very, very good thing. So to talk about that for just a minute and explain how that works is if the bond pricing was where it's at, all of the numbers were exactly the same, but we didn't have an inverted yield curve where the short terms are paying longer than or better than the long terms, our long-term interest rates would be in the mid sixes. Okay, so if nothing else, if bonds don't improve and inflation stays flat and the market stays, economy stays flat, everything else stays exactly how it is, except that inverted yield curve, fixes itself and comes back closer, just that one thing will bring interest rates down into the sixes. Okay, forget everything else that's actually happening, that's coming in the future. Once this inverted yield curve starts to fix itself, and it was a big move this week. It was almost like 18 basis points or something, 18, 20 basis points, I believe, this week that it fixed itself and it compressed a little bit. That in itself is going to help interest rates fix themselves and come down to a normal level. We should not be as high as we are. We know this. We look at the bond pricing, we look at all of the information, and nobody can really tell you exactly why interest rates are in the mid sevens with the way pricing is, with the way that we're looking at the bond charts, when we're looking at those pricing and our margins and all of those things that go into it. We really shouldn't be as high as we are, but we are, right? A lot of fear, a lot of different things going on, but the inverted yield curve is a big part of that, and that is starting to fix itself. That's going to fix itself. The Fed's going to slow down. The consensus now is that we're done with the hiking of the short-term rates. That's going to confirm inflation coming down. That's going to help interest rates come down on that end. The yield curve is going to tighten. It's going to go back to a normal yield curve. And as that happens, we're going to see interest rates come down again. If nothing else happens, everything else stays flat, it's just going to happen. Interest rates are going to come down by 1% or so. Okay, so that's coming. That's coming down the pike. The other thing that we really need to focus on in the real estate industry as a positive outlook, okay, yeah, things are tough right now. They're difficult. We spend any time talking about coaching and things like that and mindset with me, you'll know that I do not ever like to use the word hard, because what we do is not actually hard, right? It's difficult, it's challenging, but there are things that happen in life that are actually hard, right? And what we deal with every single day is not hard. Challenging, sure. Stressful, definitely. Frustrating, this week has been beyond frustrating. But they're not hard, right? So we look forward to continue moving forward with what we do and how we do things and what we're building. We have the most potential increase in demand for housing than at any other time in history coming in the next 3 to 8 years, okay? We're going to have more household formations, more people coming into the age of buying their home or first home or whatever the case is, as far as buying a second home, move up, all of that. More demand. We do not have enough supply, period. We're not going to for a number of years. So this is all information you can look up at demographics and charts and all of that you can use to share with your clients, sellers, why they want to buy the house now. Yeah, it sucks giving up a 3.5% rate and taking a 7. Sure, there's options to fix that 7 down the road, but you still have to give it up for now. But what happens when the home that they're looking at now that they want to buy is $100,000 higher in 2 years or a year and a half, right? Like, do those numbers, help them understand. Let us do those numbers for you, and we can get those different reports. If you've ever seen one from us or asked for one, you'll see it's just numbers that makes sense. We put it all in front of them so that they can make an informed decision and remove that emotion of, I'm scared to give this up and take that, okay? More household formations, more people coming into buying homes, and that is going to support, again, prices, even though it sounds as crazy as it is, and where we're at right now and where interest rates are and how unaffordable everybody believes that housing is. It's not going anywhere, guys. The home prices are going to continue to go up. And maybe we do see a dip. Maybe in 6 months, home prices are a little bit lower. Maybe, right? Doubt it. There are some things that can happen that, bring that down just a little bit where we don't get inflation. But anyway, that 6 months, okay, fine. So like a year, 2 years, they're putting things on hold. We've got people going into a lease for 12 months or 18 months because they don't want to buy because interest rates are here. Well, we got to do those numbers. We've got to educate these people so that they understand what they're giving up. They're not giving up a 3.5 to 7%, You know, that's part of it, but that's not it. They're giving up $100,000 or $150,000 or on the smaller price range, $75,000 in the next 2 years on that home appreciation, or them being able to go buy that other home because it's an additional $75,000 in cost. I don't know what the interest rate would have to be between 3.5 or 3 to whatever to cost an extra $75,000 in the next 2 years. But I guarantee you it's not 7. It's going to be, I don't even know, 200, something crazy. We need to make sure that everybody understands what those numbers are, okay? Home prices are stable, or not stable, but secure in where they're going. They're going to increase. Interest rates are coming down. They're going to come down. Sure, I know we keep saying that, and we keep looking at this, and then we get these bumps, but the market has to fix this. They have to figure out exactly where everybody wants to be and position themselves with the changes that are happening now. And this week was a big indicator on what that means and what that looks like. So we're going to have some moving around, and we're going to have big moves one direction or the other. But that yield curve fixing itself drops interest rates by itself, all the way down from where we're at today, all the way down into the 6s, okay, mid 6s or so. That by itself is a huge thing. It excites me to see that this week, even though it's a bad week and interest rates went up. Knowing what happened technically is a very, very good sign, guys. So I hope you wasn't too deep and technical and all that for you. The video was a little bit longer than normal, but take this information. Let me know if there's any information that we can give to you guys. If you guys want any charts or anything that you can look up and share with your people, we can put a little presentation together for you as well with some charts and some numbers to help with that if you like. Or we could just do a cost analysis for your sellers or your buyers, what it looks like to wait, the cost of waiting, what a higher interest rate versus $50,000 more on the purchase price if they wait. All of that, we can do that. Just let us know what we can do to help you and what's important to your buyers or your sellers, so that we can show them those numbers so they can make an informed decision rather than just watch the news and say, oh, the sky is falling, I'm not selling my home, I don't know what's going to happen, I can't take double the interest rate, I can't. If they have the information, it will help remove the emotion from our decision, and then they'll sell or not, it doesn't matter, but at least they have the information that they need to make that decision. So hope you guys have a great, productive weekend. If you need anything at all, give us a call, shoot me a text, whatever. You all have my cell phone numbers, team numbers, 214-441-7496. Hope you guys have a great weekend, productive week. Next week, we'll talk to you on Monday and let you know we've got some things happening as well. So we'll talk to you guys soon. Bye-bye.